Have you ever heard economists talk about the yield curve and wondered why they sound so worried? Most people tune it out. It sounds technical, boring, maybe even irrelevant to daily life. But here's the truth. The yield curve is one of the most reliable warning systems in the entire financial world. And right now, after years of flashing red, it is about to snap back. When it does, the consequences will ripple through every corner of the economy. Your job, your savings, your investments, everything could be affected. And most people have no idea it is coming. So what exactly is the yield curve, and why does it matter so much? Stay until the end, leave a like, and let's break down what happens when this critical economic indicator reaches its breaking point. The yield curve is actually quite simple once you understand it. It is a graph that shows the interest rates on government bonds across different time periods. On one side, you have short-term bonds, like 3-month or 1-year treasury bills. On the other side, you have long-term bonds, like 10-year or 30-year treasuries. Normally, the curve slopes upward. Why? Because investors demand higher returns for locking their money away for longer periods. That is the natural order. You take more risk by committing for 10 years instead of 1, so you get paid more. But sometimes something strange happens. The curve inverts. Short-term interest rates rise above long-term rates. The line flips upside down. And when that happens, it is like a fire alarm going off in the financial system. Historically, every major recession in the past 50 years has been preceded by an inverted yield curve. Every single one. The 2008 financial crisis, the dot-com crash, the recessions of the early 90s and 80s, all of them were predicted by this one simple pattern. So, why does an inverted yield curve signal trouble? Think of it this way. When investors believe the economy is heading into rough times, they rush to buy long-term bonds. They want safety. They want to lock in returns before things get worse. This drives long-term bond prices up and their yields down. At the same time, the Federal Reserve usually raises short-term interest rates to fight inflation. The combination causes the inversion. Short-term rates spike, long-term rates fall, and the curve flips. Now here's where it gets critical. The yield curve inverted in 2022. It stayed inverted for an unprecedented length of time, over 2 years. That is the longest inversion in modern history. And just recently, it started to normalize again. The curve is uninverting. It is snapping back. And here is the terrifying part. Historically, the recession does not hit during the inversion. It hits after the curve steepens again. The snap is the trigger. The break comes after the warning fades. Let me explain why this happens. When the yield curve inverts, it squeezes the entire financial system. Banks make money by borrowing short-term and lending long-term. But when short-term rates are higher than long-term rates, that model breaks down. Banks stop lending. Credit dries up. Businesses struggle to get loans. Consumers find it harder to borrow. The economy starts to slow. But the real damage does not show up immediately. It takes months, sometimes over a year, for the effects to fully materialize. Then, just as the curve starts to normalize, the recession hits. Think of it like a rubber band. You stretch it and stretch it. The tension builds. Everyone knows something is about to snap. But the damage happens when you let go. The yield curve works the same way. The inversion is the stretching. The snap back is the release. And the recession is the aftermath. So what does this mean right now? The yield curve has been inverted since mid-2022. It finally began steepening again in late 2024. If history repeats itself, we are entering the danger zone, the window where the economy is most vulnerable. And there are already signs that cracks are forming. Corporate earnings are slowing, consumer spending is weakening, unemployment, while still low, is ticking upward. Credit card debt is at record highs, delinquencies are rising. These are not random events. They are symptoms of an economy that borrowed too much, spent too much, and is now running out of steam. The yield curve inversion warned us. Now the snap is here. And the breaking point may be closer than most people think, but it gets worse. This time, the snap is happening in a uniquely dangerous environment. The U.S. government is carrying $37 trillion in debt. Interest rates, while coming down slightly, are still elevated compared to the past decade. That means the government is paying more to service its debt than ever before. Around $1 trillion per year just in interest. Meanwhile, the Federal Reserve is stuck. If they cut rates too aggressively to stimulate the economy, inflation could roar back. But if they keep rates high, they risk pushing the economy into a deeper recession. It is a lose-lose situation, and the yield curve snap is the catalyst that exposes it all. Now let's talk about what happens next. When the yield curve snaps and the recession hits, several things unfold almost like clockwork. First, unemployment rises. Companies that were barely holding on start laying off workers. Hiring freezes spread. Job openings disappear. Suddenly, millions of people who felt secure find themselves competing for fewer and fewer positions. Second, asset prices fall. Stocks drop as corporate profits shrink. Real estate slows as buyers pull back and mortgage rates remain high. Even bonds, traditionally seen as safe, can lose value if investors fear the government will have to print more money or default on obligations. Wealth evaporates, not just for the rich, but for anyone with a 401k, a home, or savings tied to the market. Third, credit tightens even further. Banks, already cautious, become downright stingy. Small businesses struggle to survive. Consumers max out credit cards and fall behind on payments. Bankruptcies rise. Foreclosures increase. The cycle feeds on itself. Less spending means less revenue. Less revenue means more layoffs. More layoffs mean even less spending. It spirals downward. And fourth, government debt explodes. During a recession, tax revenues plummet because people earn less and spend less. At the same time, government spending skyrockets. Unemployment benefits, food assistance, stimulus programs, all of it adds up. The deficit widens, the debt grows, and the interest payments, already at $1 trillion per year, climb even higher. It is a vicious cycle that makes the next crisis even worse. But here's the part most people miss. The yield curve snap does not just trigger a recession, it exposes the weaknesses that were hidden during the good times. Right now, the system is fragile. Consumer debt is at an all-time high. Corporate debt is massive. Government debt is out of control. The only thing holding it all together is confidence. Confidence that the economy will keep growing. Confidence that the dollar will stay strong. Confidence that the system will not break. But when the yield curve snaps and the recession begins, that confidence shatters. Suddenly, everyone realizes the emperor has no clothes. The debt was never sustainable. The growth was built on borrowed money. And the promises made to workers, retirees, and taxpayers cannot all be kept. So what can you do? How do you protect yourself when the breaking point arrives? First, understand that this is not about predicting the exact date. No one can do that. But the pattern is clear. The yield curve has inverted. It is now steepening. History says the recession comes next, so prepare accordingly. Build an emergency fund if you have not already. Aim for 6 months of expenses at minimum. In a recession, liquidity is king. You need cash on hand to weather the storm. Second, reduce debt. High-interest credit cards, variable rate loans, anything that could become a burden if your income drops. Pay it down now while you still can. Third, diversify your investments. Do not put everything in stocks. Consider bonds, commodities, even a small allocation to gold or other hard assets. The goal is not to get rich during a recession. It is to not get wiped out. Fourth, protect your income. Make yourself indispensable at work. Update your skills. Build a side income if possible. In a downturn, the people who survive are the ones who provide clear value. And finally, stay informed. Do not bury your head in the sand. Watch the data. Unemployment numbers, corporate earnings, consumer spending, credit delinquencies. These are the signs that will tell you how deep the recession might go. The yield curve is not just a line on a graph. It is a reflection of collective fear and confidence in the financial system. When it inverts, fear is rising. When it snaps back, the consequences arrive. And right now, we are in that snapback phase. The breaking point is not some distant threat. It is here. It is now. And the only question is how bad it will be. Some economists believe this time could be different. They point to strong employment numbers, resilient consumer spending, and a Federal Reserve that has more tools than ever before. Maybe they are right. Maybe the system holds together. But history is not on their side. The yield curve has been right too many times to ignore. And the fundamentals, massive debt, tight credit, slowing growth, all point in one direction. Something is going to break. The only question is when and how hard the fall will be. Because once the yield curve snaps, once the recession takes hold, there is no easy way out. The government cannot simply print more money without risking inflation. The Federal Reserve cannot cut rates to zero again without creating bubbles. And the debt, already suffocating, will only grow heavier. This is the breaking point. The moment where years of borrowing, spending, and ignoring the warning signs finally catch up. And when it happens, millions of people will be caught off guard. They will wonder how they missed the signs. They will ask why no one warned them. But the warning was always there. flashing in the yield curve, screaming in the data, hiding in plain sight. So to stay always protected, you can subscribe to this channel and let me know your thoughts in the comments. See you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.